Hey everyone, it's Griffin here. So this should be of no surprise to anyone. The real estate market's been absolutely insane over the past 3 years or so, both in Canada as well as the United States. Now, ever since the pandemic ended up hitting the world by storm, this has had massive economic repercussions basically across the board, and honestly, we have still yet to see the full impacts and repercussions. What ended up happening though is that we've seen a massive amount of capital being printed and injected into the economy in parallel to the lowest interest rates that we've seen in years. So put these two together, and now we have investors who have significantly more purchasing power and buying power being injected into the market, thus raising the overall value of the average home across North America. Specifically in Canada, it is insane, and this has now led to many investors fearing potentially an imminent market bubble that might be on the horizon. In America, we've seen the median home price rise to $346,000 in 2021, which is up nearly 17% over last year. And things are even more crazy here in Canada with home affordability that are at all-time lows, where the average home price has risen to a whopping $713,000 in December of 2021, which is also up 17.7% since last December of 2020. So ultimately, despite the fact that interest rates do still remain quite low for now, well, overall home affordability is lower than ever, because affordability comes down to the average price of a home in relation to an increase in wages, and also the capacity for the average individual to get a mortgage loan at a reasonable interest rate. Right, so we can see on this chart right here that even as of 2020, the income that was required to buy an average property in Canada is just getting higher and higher year over year. And that's because the average price of homes has been increasing at a much quicker pace than wage increases, which creates a larger and larger gap in home affordability for the average individual, which is ultimately the main reason why it's becoming harder than ever for first-time homebuyers to just get some skin in the game. And even further, taking a look at this chart right here, we're hit with data that's even more striking, where especially in Canada, the discrepancy between wage increases and home price increases is just flabbergasting. There's really no other way of putting this than the fact that this is a problem.
Houston, we have a problem.
And that's why I wanted to make today's video, going over a couple different pain points that many of my viewers have brought to me when speaking about either purchasing a home or purchasing a rental property. But before we dive into that, I want to speak about interest rates, because this is really one of the main factors impacting house prices, and then also one of the main things that many people are banking on, an increase in interest rates over the coming months and years that will probably have an impact on lowering the overall housing market price point, average price point. And I just want to say that if at any point in today's video you enjoy the content, please make sure to smash the like button. It really helps my channel grow when the YouTube algorithm sees a higher amount of likes. So let's get into it. All right, so all other things being equal, it's important to first understand the fact that someone, say, making $50,000 a year can theoretically buy a home that is more expensive at a lower interest rate than that same home at a higher interest rate. And this is because interest rates have a direct impact on home affordability. Right, so for example, a house that's $350,000 at 20% down and a 2% interest rate over 25 years would be $1,190 per month in mortgage payments. Now, when we look at that same home with everything else being equal, only thing that's changed is the interest rate now up at 3.5%. The monthly mortgage payment is $1,400, which makes a big difference for most people. So the issue now though is the fact that at the beginning of the pandemic, when the interest rates first dropped, well, this did materially impact home affordability, where it was a lot more affordable to purchase a home. Now that so many people have piled into the market though, and house prices have increased so dramatically, this has actually somewhat nullified the overall impact of lower interest rates. So right now, the only things that can really lower this gap in terms of home affordability in Canada are two things. One, either wage increases, which realistically just isn't going to happen in the short term, and or seeing interest rates rise, which should have an impact on lowering or at least very much cooling off the increases in house price appreciation basically across the nation. Now, a couple of months back, I did release a video speaking about whether or not you should be looking to purchase a house right now, or whether or not waiting might make sense for the market to cool off to get a better deal. And the general consensus from that video though was the fact that based on all the data I was able to gather, even though there is quite a bit of data that could lead to thinking there would be an imminent market bubble, well, on the flip side, there's also a lot of data showing that right now the market could remain very expensive for years down the line, even if we do see the interest rates increasing. And I really just don't think we're going to be seeing a 30-40% market decline that many investors are hoping for to get into the market. Because here's the thing, even if interest rates increase, well, this is going to have an impact on variable interest rates. And taking a look at this chart right here, we can see that the number of variable interest rates that have been taken out on properties over the past 2 years has dramatically increased. However, when the interest rates increase, the monthly payment is going to remain the same. The only difference is that the percentage of interest versus equity being paid down on that same monthly payment is going to differ. So right now, for the market to actually drop dramatically, we need to see a massive influx of amount of properties entering the market to flood the market and therefore drop the overall average price point in most of these hot markets across the nation. In parallel to this, down in the United States, we're seeing the 30-year fixed mortgage rates increasing to 4.23%, which is definitely much higher than the lows that we saw in 2020 and even last year, and is also a sign that the market is starting to definitely price in interest rate increases. However, this doesn't necessarily have a one-to-one correlation with a large market drop like, again, many investors are anticipating and hoping for to get into the market at a lower price point. I really just think we're going to see the market plateau over the next year or two and then see where it goes from there. And actually, when we even take a look at the data, the relationship between interest rates and home prices isn't actually as synonymous as many might believe. There isn't necessarily a direct link between the interest rates and then the average price of homes. Just take a look at this chart right here where we can see interest rates dropping since basically the 80s, but house prices just continuing to rise year over year on a steady pace. So all that being said, ultimately, like everyone else, I don't have a crystal ball. Wish I did, but time will tell whether or not we're going to see a larger market correction or even crash in the real estate market across North America rather than a cool off and stabilization. Okay, so I promise that covers all the theory we're going to be covering in today's video. Let's now talk about a bit more practical advice, because despite everything we just spoke about and the fact that the housing market is extremely hot and expensive right now, well, over the past 2 years, I've still managed to do multiple deals in real estate, purchase a house, fix it up, increase the value of multiple different properties. Basically, I've been investing in real estate throughout this time, and I'm absolutely passionate about real estate investing. And every time I talk about it, though, on the channel, I do typically get a lot of people who are very interested, but then also a lot of people who are skeptical and might have some certain pain points depending on, the area they're in or whatnot. So I wanted to cover a couple different pain points and try to give some advice, or basically just some guidelines as to what I would maybe do in certain situations. Okay, so pain point number one is the one I hear most often, especially for newer investors, and that is no money, right? Lack of capital to put into a deal as the down payment, closing cost, whatever, lack of money to fund a deal. And there are a couple different things that initially come to mind for me when it comes to solving this issue. The first one is the fact that if it's your first property, I would always recommend putting 5% down on the property, right? This is what's called an owner-occupant loan. And anyways, I usually recommend that one of the first and easiest ways that you can get your foot in the door when it comes to real estate investing is to house hack. Really simple. Basically, you can either buy, let's say, a single family home, rent out some of the bedrooms or rent out the basement to another tenant, or you could buy a duplex, live in one unit, rent out the other, triplex, same concept. Whatever, house hacking is an easy way that you can get your foot in the door when it comes to real estate investing and start getting knowledge in that world. Now, 5% down though is going to be required when you're looking at an owner-occupant loan. And the reason why I think this is great is because 5% down on, say, a $500,000 property only represents a much smaller amount, $25,000, versus say 20% down is $100K on that first property. And for most new investors, that's a massive difference, right? The difference between saving $25,000 versus $100,000 can usually be years upon years of saving and investing, in which time the market may have appreciated by 50, 100% like we've seen over the past 5 years or so. So the way I see this is that it really comes down to opportunity cost, right? Let's say you did save up to 20% down, which is the typical amount that you need to fund a deal. Well, at 20% down, now let's say you have $100K, you've just frozen that into a property. Now you have no other capital to invest with elsewhere and try to create a return on your investment. Now, most of the time when people say that 5% down isn't an appropriate option, it's because they're talking about the mortgage interest that you have to pay on that loan. Mortgage interest essentially is an amount that you have to pay in order to cover basically your loan when it's less than 20%. This is paid off though over the entirety of your loan. If you take a 25-year loan, it's going to be over 25 years, 30-year loan, 30 years, etc., right? So this isn't something that you're paying right up front. You're paying a small portion every single month over 25 years. And usually when it comes to the opportunity cost of being able to buy your property now versus years down the line, that's not really going to make a big deal in the big picture anyways. And if it's a rental property, it really doesn't matter if the numbers make sense anyways, and that is taken into account into the numbers regardless. The second solution to lack of funds would be partnering up. Now, of course, this has become a little bit more complex if you're buying, say, a house to live in and you're not buying it with a spouse, right? Buying a house with a partner, a business partner, I should say, it might be a little bit more difficult. But if you're looking to buy a rental property, partnering up can be a great option. First of all, it splits the risk between the both of you, or maybe even three people. And then also the amount that you need to put out of your own pocket into the deal is significantly less. On that same example from earlier, $25,000 down at 5%, well, now it would be $12,500 each, which is significantly less and a lot more achievable for most people. And by the way, this is something I've personally done on multiple different deals. All I would say about this though is that if you are going to be purchasing a property with a partner, make sure it's someone that you fully trust and intend on potentially doing business with for the long term. Solution number 3 to lack of funds is going to be increasing your income, which I know sounds really simplistic, but ultimately when it comes to basically any investment, trying to accelerate your rate of investing comes down to first increasing your income. I know that does sound really sort of repetitive, but that's the reality of things. Increasing your income while lowering your expenses is going to increase your savings rate. I'm going to leave a video down below in the description about a video that I made recently speaking about how I've been able to increase my savings rate, but ultimately it just comes down to increasing your amount of income. So look for a promotion at your job, maybe a second job, a side hustle, whatever you're able to do in the short to medium term to increase your income is going to dramatically impact this pain point. And then finally, potentially borrowing against your other assets. Now, this might not make sense for most people watching this, especially if you're a new buyer and you don't necessarily have a lot of capital to work with. But if you do have, say, a home and you're looking to purchase your first rental property, chances are you might have quite a bit of equity tied up and built in your home that you can use in order to fund your first deal. That is absolutely an option that many people don't even realize that they have, borrowing against, say, their first property or their main residence, I should say, or even sometimes some other types of assets. That is also a potential option. Okay, moving into the second pain point that I hear about all the time, and this is arguably one of the largest bottlenecks for most new investors. That's going to be, hey, I can't get approved for a mortgage loan and my credit isn't necessarily at the place it needs to be in order to get approved for a loan. And when it comes to the world of real estate investing, this is an extremely important element. You need to be able to access credit in order to get loans on your mortgages and therefore increase your return on investment. So this is definitely a really large pain point. Number one, this should go without saying, you need to work on increasing your credit score as well as just getting your credit report and your overall file in better standing. So this is ultimately just going to come down to making sure that you never miss a payment for at least a year or two before applying for your mortgage loan, paying those off consistently, making sure that your balances aren't extremely high, basically just keeping your credit in check and making sure that you never miss a payment so that your credit is really top notch when you apply through a mortgage broker to get a mortgage loan on a property. That is extremely important. If you have a very low credit score, say 600, 550, it's going to be a lot harder to get A lenders, and also your rate is probably going to be quite a bit higher. Number two, you need to increase that income. Again, I cannot stress this enough. Not only do you need to increase your income to be able to save up for your down payment, but also when it comes to the underwriting of your loan and a loan officer looking at whether or not they're going to lend you that mortgage capital, well, they're going to take a look at your debt to equity ratio as well as income to debt ratio. So if you make, say, $30,000 a year and you have car payments, well, that's probably going to be a really low income to debt ratio, and therefore you might not be able to get approved for that loan. If you increase your income though, you're making now $75,000 a year and your debts are extremely low, well, therefore you're probably going to be in a better position and a better standing to get approved for mortgage loans. That is going to be one of the most important things in basically everything that has to do with finance. payments. So going hand in hand with that last point, get a job. That is number 3 here. And it sounds really simplistic, but when a loan officer looks at your application for a mortgage loan, usually they really like to see consistent income coming in. So if you work part-time, for example, and you've been all over the place switching jobs, usually that's not what they want to see. They want to see consistent income coming in from the same employer. Again, make sure to talk with a mortgage broker for more detailed and specific examples that apply to your situation. But typically, getting a job is one of the first and most important things, and at least securing that first property. In fact, I made it an absolute must to get a couple different mortgages before transitioning away from my steady government job a couple years back to doing YouTube as well as other investing full time, right? Because had I just quit my job and gone full-time YouTube, absolutely I would not have been able to get approved for any of the loans on my current property. So that was an absolute must for me. And if you're really serious about real estate investing, making sure to maintain a job at the beginning at the very least is going to be really important. And then finally, once again, partnering up, right? So a joint venture, like we spoke about earlier, not only could this potentially allow you to get to your down payment quicker, but then also when you're applying for a loan, the loan officers are going to take a look at the income of both parties as well as the debts of both parties. If you're, say, really capped out at your debt to income ratio, well, that other individual coming into play could also have a positive impact on your potential to get approved for that loan. That is something, again, that I've done in the past and could definitely recommend if you're not necessarily in a place where you could get approved on your own for a loan on a rental property. Pain point number 3 is a lack of inventory that absolutely every single real estate investor, including myself, as well as basically every single potential home buyer is faced with right now. And ultimately, based on all the data we looked at the beginning of the video, I think is going to be a pain point for the foreseeable future, unfortunately. But really, all I can say about this is that you need to be constantly scouring the MLS and working with a realtor in order to pinpoint certain properties that fit your criteria. And again, just always having your eye on the market. This is something that I've been faced with since the beginning of starting to invest in real estate. The inventory has been low constantly. So this is why most of my deals are 3 to 6 months apart, because I personally have just really specific criteria on what I'm looking for. And so those pop up really uncommonly. And then also there's usually a lot of competition on those deals. So I will let you in on one nugget of information that I usually do though. Typically a property is going to go through a financing period. At least here in Quebec, there's a financing clause where usually when you're purchasing a property, you have, let's say, 50 or 2 weeks, let's say, to 30 days to get your financing in order. If, say, I am interested in a property and I've lost a deal to another buyer, I'll put that in my calendar and basically follow up with my agent a month later to say, hey, is this property still going through with that initial offer, or has it gone back on the market? And every once in a while, that property comes back on the market, but isn't advertised as much like when it first hits the MLS. So this is a way that you can maybe scoop up a property that's fell between the cracks, and that is also something that I've done in the past myself. Because otherwise, the only real thing you could do is sit, be patient, and wait for the market to potentially cool off as well as potentially drop in value. But again, I don't think this is going to be happening in the near future, but who knows, it could happen. And finally, pain point number 4, the market I currently live in is too expensive. Look, I live in the Ottawa-Gatineau region. This is something that I deal with constantly, where I've seen the price of houses and rental properties go up 50 to 100% in the past couple of years. And that's just the reality of things. So if you're going to be a real estate investor, you need to be willing to drive 30 minutes, an hour outside of your market in order to do deals in an area that might be significantly cheaper, especially when you're first starting out. Typically, outside of the really hot markets, so Vancouver, Toronto, Ottawa, Montreal, a bit on the outskirts of these markets, you're going to find now properties that are cash flowing and that are significantly cheaper in value. Now, of course, I'm making this once again sound a lot easier than it potentially is, but when it comes to being a real estate investor, again, it is very much more of a business, so you need to be willing to think outside of the box and basically find solutions to these problems. Just saying that my market is too expensive isn't necessarily a reason to not be looking further to make a deal if that's really something that you want to do in the short term. The best bet is always to have a really competent mortgage broker as well as a really competent realtor on your team and on your side so that you can give them the criteria you're looking for, and then probably the realtor more than the mortgage broker is going to be able to help you pinpoint properties that are going to fit in your criteria. So I hope this helped with some of the main pain points I get asked all the time when it comes to rental property investing. If you have any other questions or pain points, make sure to comment down below below what they are, and I'll try to answer as best as I can. Now, if you enjoyed today's video, make sure to smash the like button. It really helps the channel out and helps grow the audience, as well as if you want to learn more about rental properties, as well as stock market investing and other types of investing, make sure to subscribe to the channel, hit the bell button to be notified of new and upcoming content. So on that note, thanks a lot for watching today's video, and I'll see you in the next one.